After studying this module, we shall be able to understand income statement using absorption costing technique, learn income statement using marginal costing technique, know projected income statement under absorption costing, learn projected income statement under marginal costing, and evaluate difference in profit under two techniques. Practical aspect of marginal and absorption costing. Both marginal and absorption costing are techniques for calculating income at the end of specific period. Period for such calculation depends upon the business or firm for which income is to be calculated. We have studied the basic difference between both the methods is on account of the treatment of fixed manufacturing overheads in the previous module. In the variable costing, fixed manufacturing overheads are considered to be period costs, that is, they are the function time, whereas in absorption costing, fixed manufacturing overheads are considered to be product cost. Due to this difference, there is a difference in inventory valuation which indeed causes difference in profit under both techniques.
Now we will see specific income statement under both the techniques. The first one is income statement under marginal costing. In this, you have to take sales, name it A, less variable cost of production, which includes direct material, direct labor, variable manufacturing overheads. Cost of goods manufactured, you have to add beginning inventory, cost of goods available for sale, less closing inventory. This gives you cost of goods sold B. C would be marginal contribution, which is given by A minus B, less fixed manufacturing overhead, variable selling and administrative expenses, fixed selling and administrative expenses. This gives you total non-production cost D. Net income C minus D.
Income under marginal costing technique can be computed by following some steps such as number 1, sales value can be computed by multiplying units sold and price per unit. 2. Variable production cost includes costs for direct material, direct labor and variable overheads. This can be computed by multiplying per unit material, labor cost and labor overhead cost with units produced respectively. 3. By adding all the variable costs, we shall get cost of production. 4. In cost of production, we shall add value of opening inventory to get cost of goods available for sale. 5. From cost of goods available for sale, we shall deduct value of closing inventory to get cost of goods sold. 6. Valuation of opening as well as closing inventory is done through including only variable production cost, which is considered to be product cost. Here, with variable production cost, we mean direct material, direct labor and variable manufacturing overheads. 7. Now, next step is to get marginal contribution, meaning sales value minus variable cost of goods sold. 8. Now, to arrive at net income, we need to deduct all period costs from the marginal contribution. With period cost here we mean by fixed manufacturing cost, fixed and variable administrative costs and fixed and variable selling and distribution costs.
Illustration for projected income statement under marginal costing. The year 2013 and 14 we have selling price of 15 and 15 rupees per unit. The quantity of goods sold is 20,000 and 23,000. Production actual is 25,000 and 19,000. Budgeted production is 30,000 each. The costs include direct material, which is rupees 3 per unit and 3 per unit. The direct labor also remaining the same, which is rupees 3. The cost: direct material rupees 3 per unit, rupees 3 per unit. Direct labor for each year is rupees 2 per unit. The variable manufacturing expense is rupees 1 per unit. Fixed manufacturing cost is rupees 90,000 per annum each year. Variable administrative cost is 0.50 rupees per unit each year. Fixed administrative cost is rupees 25,000 per annum each year. Variable selling and distribution cost is rupees 1.50 per unit each year. Fixed selling and distribution cost is rupees 35,000 each year. We have to compute under marginal costing actual income for 2013 and projected income for 2014. The solution: income statement under marginal costing for the year 2013. The sales being rupees 3 lakh less variable cost of production, which includes direct material of 75,000, direct labor of 50,000, variable manufacturing overheads of 25,000, gives you cost of manufactured goods at 1,50,000. You have to add the beginning inventory, which is nil. The cost of goods sold for sale is rupees 1,50,000 less closing inventory, which is 30,000. The cost of goods sold gives you B, which is 1,20,000. The marginal contribution, which is given by C, is A minus B, which is 1,80,000. You have to subtract the variable administrative expense, which is 10,000, variable selling expense, which is 30,000, fixed manufacturing overhead, which is 90,000, fixed administrative expenses, which is 25,000, and fixed selling expenses, which is 35,000. The total non-production cost D is 1,90,000. The net income is given by C minus D, which gives us 10,000. For the year 2014, we have sales A as 3,45,000. The variable cost of production, which is direct material 57,000, direct labor 38,000, variable manufacturing overheads 19,000, needs to be subtracted, which gives us the cost of manufactured goods at 1,14,000. Now you have to add the beginning inventory of 30,000. The cost of goods available for sale now becomes 1,44,000. You have to subtract the closing inventory, which is 6,000. This gives us the cost of goods sold B, which is 1,38,000. The marginal contribution C is given by A minus B, which is 2,07,000. You have to subtract the variable administrative expense at 11,500, variable selling expense at 34,500, fixed manufacturing overheads at 90,000, fixed administrative expenses at 25,000, and fixed selling expenses at 35,000. The total non-production cost D comes out to be 1,96,000. In order to find the net income, we have to subtract C and D. This gives us 11,000. Now you have a working note for this. The sale value for 2013 is 20,000 into 15, which gives us 3 lakhs. For 2014, the same sales value becomes 23,000 into 15, which is 3 lakh 45,000. The direct material for 2013 is 25,000 into 3, which gives us 75,000. The direct material cost for 2014 is 19,000 into 3, which is 57,000. The direct labor cost for 2013 is 25,000 into 2, which gives us 50,000. For the year 2014, the same becomes 19,000 into 2, that is 38,000. The variable manufacturing expense is 25,000 into 1, which is 25,000 for the year 2013. For the year 2014, it becomes 19,000 into 1, which is 19,000. The opening inventory is nil in case of 2013. For 2014, it becomes 25,000 plus 0 minus 20,000, which is 5,000 units. The closing inventory for 2013 is 25,000 plus 0 minus 20,000, which is 5,000 units. The closing inventory for 2014 becomes 5,000 plus 19,000 minus 23,000, which is equal to 1,000 units. The value of opening inventory is nil in case of 2013. The value of opening inventory in case of 2013 is nil. The value of opening inventory in case of 2014 is 5,000 into 3 plus 2 plus 1, which is 30,000. The value of closing inventory for the year 2013 is 5,000 into 3 plus 2 plus 1, which is 30,000. The value of closing inventory for the year 2014 is 1,000 into 3 plus 2 plus 1, which is 6,000. Variable administrative cost is 20,000 into zero point 0.5, which gives us 10,000. For variable administrative cost of 2014, we have 23,000 into zero point 0.5, which is 11,500. The variable selling cost for the year 2013 is 20,000 into 1.50, which is 30,000. The variable selling cost for the year 2014 is 23,000 into 1.50, which is 34,500. We have to remember that closing inventory is equal to opening inventory plus production minus sale. Income statement under absorption costing. In this, we have to see the sales, which is given by A, less the cost of production, which is direct material, direct labor, and variable and fixed manufacturing overheads. This gives us cost of manufactured goods. We have to add the beginning inventory, which is the cost of goods available for sale. We have to subtract the closing inventory. This gives us the cost of goods sold. You have to add under absorbed fixed manufacturing overhead less over absorbed fixed manufacturing overhead. This gives us B, which is the cost of goods sold at actual. The gross profit C is given by A minus B. Subtracting the variable selling and administrative expense, the fixed selling and administrative expense, we get D, which is total non-production cost. The net income is C minus D.
Income can be computed by following steps. 1. Sales value can be computed by multiplying units sold and price per unit. 2. Production cost includes cost for direct material, direct labor, and fixed and variable overheads. This can be computed by multiplying per unit material, labor cost, and manufacturing overhead cost with units produced respectively. 3. By adding all the production costs, we shall get cost of production. 4. In cost of production, we shall add value of opening inventory to arrive at goods available for sale. 5. From cost of goods available for sale, we shall deduct value of closing inventory to get cost of goods actually sold. 6. Valuation of opening as well as closing inventory is done through including both fixed and variable production cost, which is considered to be product cost. Now, next step is to get gross profit, which can be obtained by subtracting sales value from cost of goods sold. 7. Now, to get net income, we need to deduct all period costs from the gross profit. With period cost, here we mean fixed and variable administrative costs and fixed and variable selling and distribution costs.
Illustration for projected income statement under absorption costing. The year 2013 and 2014. The selling price in 2013 is rupees 15. The quantity sold is 20,000. The production actual is 25,000. The budgeted production is 30,000. The costs include direct material cost, which is rupees 3 per unit. It also includes the direct labor cost, which is rupees 2 per unit, and the variable manufacturing expenses, which is rupees 1 per unit. The fixed manufacturing cost is at rupees 90,000 per annum. The variable administrative cost is rupees 0.5 per unit. Fixed administrative cost is rupees 25,000 per annum. Variable selling and distribution cost is rupees 1.50 per unit. The fixed selling and distribution cost is rupees 35,000 per annum. For the year 2014, the selling price is rupees 15 per unit. The quantity sold is 23,000 units. The production actual is 19,000. The budgeted production is 30,000. The costs include the direct material cost, which is rupees 3 per unit, the direct labor cost, which is rupees 2 per unit. The variable manufacturing expense is at rupees 1 per unit. The fixed manufacturing cost is rupees 90,000 per annum. The variable administrative cost is rupees zero point 0.5 per unit. The fixed administrative cost is at rupees 25,000 per annum. The variable selling and distribution cost is rupees 1.50 per unit. The fixed selling and distribution cost is rupees 35,000 per annum. We need to compute under marginal costing actual income for 2013 and projected income for 2014. The solution: income statement under marginal costing. For the year 2013, the sales is 3 lakh less variable cost of production, which includes direct material, that is 75,000, the direct labor 50,000, variable manufacturing overheads, which is 25,000. The fixed manufacturing overheads is 75,000. The cost of goods manufactured is 2,25,000. We have to add the beginning inventory, which is nil in this case. This gives us the cost of goods available for sale, which is 2,25,000. We have to subtract the closing inventory, which is 45,000. This gives us the cost of goods sold, which is 1,80,000. We have to add under absorption of fixed manufacturing expenses 15,000. This gives us B, which is the cost of goods sold actual, which is 1,95,000. C gives us gross profit, which is A minus B, this is 1,05,000. Less variable administrative expenses, which is 10,000, variable selling expenses 30,000, fixed administrative expenses 25,000, and fixed selling expense 35,000. This gives us total non-production cost D, which is 1 lakh. Net income is C minus D, which is 5,000. Similarly, for the year 2014, if we calculate, we have sales A at 3,45,000, less variable cost of production at 57,000, direct material cost at 57,000, direct labor cost at 38,000, variable manufacturing overheads at 19,000, fixed manufacturing overhead at 57,000. This gives us the cost of goods manufactured at 1,71,000. We have to add the beginning inventory, which is 45,000. The cost of goods available for sale is 2,16,000. Less inventory of 9,000 gives us the cost of goods sold, which is 2,07,000. We have to add absorption of fixed manufacturing expenses of 33,000. This gives us B, which is the cost of goods sold actual at 2,40,000. The gross profit C, which is A minus B, is now 1,05,000. We have to subtract from this the variable administrative expense, which is 11,500, the variable selling expenses at 34,500, the fixed administrative expenses at 25,000, and the fixed selling expenses at 35,000. This gives us the total non-production cost D, which is 1,06,000. The net income C minus D.
Now, we would learn about the reasons for the difference in profit under marginal and absorption costing methods. To understand why there is a difference in profit under marginal and absorption costing, we need to fully understand the process of ascertaining cost of production and net income. If we carefully check out for the difference in the process, we will find that the difference lies in the cost of production under two methods. For marginal costing, cost of production is being calculated without including fixed manufacturing costs, while under absorption costing, fixed manufacturing cost is not included in cost of production. Due to this inclusion of fixed manufacturing cost in cost of production under absorption costing, there are differences in value of opening and closing inventory, as value of inventory is dependent on cost of production. As already discussed, under marginal costing, for valuation of inventory, we take only variable production cost. On the other hand, under absorption costing, we take all production cost, whether fixed or variable. Now, we can evaluate the difference in profit under both the methods and relate it to the value of inventory, which is different under both the methods. We can consider three scenarios wherein number 1, production is equal to sales. 2, where production is greater than sales. 3, where production is less than sales. First scenario. In the first scenario, where production is equal to sale, profit will be equal under both techniques. The reason for this can be attributed to the fact that the value of opening and closing inventory is the same. Second scenario. In the second scenario, where production is greater than sales, the profit will be lesser under marginal costing technique as compared to profit calculated under absorption costing technique. The reason for the difference is that production is higher than sales. Therefore, inventories are being built up, and under absorption costing, a part of the fixed manufacturing cost is being carried forward to the next period, which causes decrease in the actual cost of production as compared to marginal costing. So, profit is higher under absorption costing and vice versa when sale is greater than production. The third scenario. In the third scenario, where production is less than sale, the profit will be reflected higher under marginal costing technique than the absorption costing technique. Hence, we can conclude that marginal costing rewards sales as it shows higher profit as compared to absorption costing when sale is greater than production, while absorption costing rewards production as it shows higher profit when production is greater than sale. Let us now recapitulate what we have learned in this module. We have learned the technique for calculation of profit under marginal and absorption costing methods. The main difference under both the techniques is the treatment of fixed manufacturing overheads. In case of absorption costing, profit is more than marginal costing when production is more than sales and vice versa.